I'm Susan McGinnis in the Energy News Center. Crude oil prices drifted below $82 a barrel late in the week after rising nearly $14 over the last month. Slack demand has been battling signs of a steadily improving U.S. economy. Meantime, natural gas prices fell after the EIA said that stockpiles dropped, but less than expected for last week. Prices are down more than 30% so far this year. Elliott Gue of the Energy Letter and the Energy Strategist joins us now for some more insight. Elliott, good to see you.
Good morning.
Now, starting with crude oil prices, they've traded between $70 and $85 for months now. What is your take on where demand is right now versus these signs of economic recovery?
Well, I think demand in the U.S. is pretty much stabilized, maybe ticking a little bit higher now. Certainly very sluggish demand growth in the U.S. And that should improve gradually as we move through the year, because I think we'll continue to see this sort of gradual cyclical upturn in the economy. We got some industrial production figures the other day, which were quite positive, and that should help the industrial demand for crude oil as well.
Well, we had Phil Flynn at PFG Best say that the big question right now is this $85 even justified? So do you think we might be looking at a drop from here in the short term? I
wouldn't be surprised to see some volatility around there, but I think that crude oil prices around 80 are probably justified. I think that the global demand is really the story. We're seeing very strong demand growth in places like China and India, and that's really offsetting pretty weak, sluggish growth in places like Europe and the United States.
So this is about emerging, developing countries.
Absolutely, and it's much more so than it was, say, 10 years ago. I think a lot of people, especially people who've been trading oil futures, for example, for many decades, still tend to look too much at EIA data and what's going on in the U.S. Because really, the U.S. used to be the sole driver of the global crude oil market. You could pretty much look at the state of the U.S. economy and tell whether crude oil prices were going to be strong or weak. But you can't really do that anymore. You saw the statistics. Saudi Arabia now last year sent more oil to China than they did to the United States. And that's really just symptomatic of the overarching trend where those countries are seeing very strong growth and very price insensitive growth, whereas the U.S. demand is pretty flat.
So this week's inventory report is not figuring greatly in your thought process?
Short term, it certainly does. We saw inventories this week pretty much better than expected across the board. Crude oil inventories rose a little bit, but less than expected. Gasoline inventories fell about twice as much as had been expected, and distillate inventories also fell a little bit more than expected. So short term, that's definitely an upside driver for the oil market. And if you're trading oil futures, that's certainly going to cause you to put a bid under oil prices. Technically, looking at the charts, we're reaching an area we call resistance level, which is really the January highs for oil. It's around 83.95. So really, you're going to see some selling when you get back to that level, because people that are trading oil are going to sell down the futures a little bit at that level. I think if we get through that level, you're going to see $90, $95 a barrel oil very quickly.
Okay, so as oil prices head in that direction, we have natural gas prices going the opposite way. What's your take on this week's inventory report? How important is that to prices?
Well, this I think shocked a few people because it was so much less than expected. It was about 11 billion cubic feet. The consensus was up around 30 billion cubic feet for a drawdown. There was a pretty wide range of estimates, though. They were as low as sort of 10 billion cubic feet, and as high as I think 70 on the high end. So there was a pretty big range of estimates there, and I think that reflects sort of the general uncertainty about how natural gas inventories are going to build here over the next few months. Pretty much winter heating season is over. You're seeing pretty warm temperatures across much of the U.S. this week. And that's going to mean that the heating demand is gone for oil, for natural gas rather. But the other sources of demand, industrial demand, should recover. Natural gas looks very positive as a feedstock right now compared to oil.
So how does that stack up against the supply situation in the U.S.?
Right. That's the big question. How much supply growth are we going to see as a result of increased drilling activity in these shale plays? Will that swamp any recovery in demand that we see? I think it's almost a certainty right now that if things continue as they are, we'll see pretty strong demand growth for natural gas in the electrical power sector. It's actually cheaper than coal in some parts of the country right now, even without a carbon cap and trade system. And you're going to see industrial demand growth for natural gas as a replacement for oil. But will the supply from these shale finds be so much that it'll swamp that demand? or will it be more balanced than the market expects?
We've talked before about this shale story going global, and now we're hearing that Europe, at least some experts say, will not match the shale boom the U.S. has seen, that it's just too challenging right now. Do you agree? Do you think the story is just too early for outside the U.S.?
It's absolutely too early because the infrastructure just isn't there. Nobody has really tested out these or proved out these shale finds in Europe. I mean, there's been some drilling, but certainly nothing along the lines that we see in the U.S. And there is no shale gas drilling industry, unconventional gas drilling industry in Europe.
What about exploration? What about seismic studies? Do they even know where all the shale is everywhere else?
They don't know where all of where it is. They sort of have done some general studies that show that there are similar formations to things that we see in the United States. Nobody has any idea whether they would be more expensive to drill and produce than, say, the U.S. shale finds, or less expensive. My guess is they'll be more expensive, again, partly because the infrastructure just isn't there.
But aren't we seeing a land grab of the same type we saw here by U.S. companies overseas, Exxon, Shell, and others?
Yeah, you certainly are. You're seeing the big players, Exxon being one of them.
They just want to get in early.
They want to get in early, and they bought XTO with a long-term view of maybe being able to take some of that technology that has been honed in the U.S. and that know-how and use it abroad. But remember, it took a long time for U.S. shale gas industry to develop. I mean, this thing started back in the 80s, with Mitchell Energy. A lot of people thought he was sort of just sort of crazy for buying up all that land in the Barnett. And it took a long time for it to actually develop. Now, I don't think it would take as long abroad because they sort of have the U.S. model to go by. But it's still going to take time to get, to figure out what land is really most prospective for shale gas, to do the exploratory drilling required, and to get the people and equipment in place to actually produce it.
So for now, at least, this is all good news for Gazprom, and the other countries will remain dependent.
I think that's very much the case, and I think that Gazprom is also, if you look at some of their pipeline flows, they're also shifting some of their market from traditional markets in Europe to Asia. And so Asia, in terms of their shale, it's probably even a little bit further behind Europe. So it's really a question of, even if it takes a number of years for shale unconventional gas production in Europe to ramp up, Gazprom may have plenty of time to find other markets.
Right. Okay. Elliott Gue, energy strategist, thanks for your insight.
Thanks for having me.
We appreciate it. We'll see you next time. And I'm Susan McGinnis. You're watching Clean Skies News.